Did you know that if you had invested just $100 in Amazon when it first went public, today that investment would be worth over $120,000? Quite an astounding fact, isn't it? This is the surprising potential of investing. It's not about quick riches, but the power of compound interest and steady growth over time. Imagine what could happen if you put more than just $100 into a thriving enterprise. But investing isn't just about picking the next big winner. It's about understanding the basics, making informed decisions, and being patient. This is where we come in. Our mission with this video is to guide beginners, maybe like you, through the fascinating world of investing. We'll cover everything from setting your investment goals and understanding risk tolerance to the intricacies of different asset classes and investment vehicles. We'll even delve into the debate between active and passive investing. We'll help you navigate these waters and set you on the path to a successful investing journey. So, ready to transform your financial future? Stick around and let's demystify the world of investing together. Before you start investing, it's crucial to understand your goals and your risk tolerance. Think of your investment goals as the destination on your financial journey. These goals could range from saving for a new home, funding your child's education, or achieving financial freedom. It's important to set clear, realistic goals as they will guide your investment decisions and help determine the most suitable investment strategy for you. Now, let's talk about risk tolerance. This is essentially your emotional and financial capacity to withstand potential losses. Some people might be comfortable with high-risk investments for potentially higher returns, while others might prefer safer, lower-risk investments. Your risk tolerance is largely influenced by factors such as your financial situation, age, and investment horizon. For instance, younger investors might be more willing to take on riskier investments as they have more time to recover from potential losses. Conversely, those nearing retirement might lean towards safer investments to preserve their capital. It's crucial to accurately assess your risk tolerance as it plays a significant role in determining the type of investments to consider. High-risk investments can lead to high returns, but they can also lead to substantial losses. On the other hand, low-risk investments may yield lower returns, but they offer more stability. Remember, understanding your goals and risk tolerance is the first step towards successful investing. Now, let's dive into the world of asset classes and investment vehicles. When we talk about asset classes, we're referring to groups of investments that behave similarly and are governed by the same laws and regulations. The three main types of asset classes are stocks, bonds, and real estate. Stocks, also known as equities, represent ownership in a company. When you buy a stock, you become a fractional owner of that company. Stocks have the potential for high returns, but they also come with a higher risk compared to other asset classes. Then we have bonds, which are essentially loans that investors make to entities like governments or corporations. In return, these entities pay interest to the bondholder over a certain period, and at the end of that period, the original investment is returned. Bonds are generally considered lower risk than stocks, but their potential returns are also typically lower. Lastly, we have real estate. This can include everything from residential properties to commercial buildings and land. Real estate can generate income through rent and can also appreciate in value over time. Now, let's talk about investment vehicles, which are the methods through which you can invest in these asset classes. Mutual funds and exchange-traded funds, or ETFs, are two popular investment vehicles. Mutual funds pool money from many investors to invest in a diversified portfolio of assets. They're managed by professionals and can be a good option for those who prefer a hands-off approach to investing. On the other hand, ETFs are similar to mutual funds but are traded on the stock market, meaning their price can fluctuate throughout the trading day. They offer more flexibility than mutual funds and often have lower fees. In the end, it's all about finding the right balance based on your risk tolerance, investment goals, and time horizon. Choosing the right asset class and investment vehicle can greatly impact your investment returns. Have you ever wondered about the difference between active and passive investing? Well, let's break it down. Active investing is like being the captain of your own ship. You're at the helm, making decisions about which stocks to buy, when to sell, and how to navigate the choppy waters of the financial markets. It requires research, time, and a good understanding of the market dynamics. It's exciting, but it can also be risky. On the other hand, passive investing is more like setting sail and letting the wind take you where it will. This strategy involves investing in a diverse range of assets, often through index funds or ETFs, and then essentially letting it ride. It requires less time and knowledge as you're not making constant buy and sell decisions. Plus, it often comes with lower fees, but it also means you're at the mercy of the market's ups and downs. So, which one is right for you? That depends. If you enjoy the thrill of the chase and have the time and knowledge to dedicate to it, active investing might be your style. But if you prefer a set-it-and-forget-it approach and value consistency over time, then passive investing could be a better fit. Remember, there's no one-size-fits-all answer here. It's about finding the strategy that aligns with your goals, your risk tolerance, and your lifestyle. And here's a little secret. You don't have to choose just one. Many successful investors use a mix of both strategies. Whether you choose active or passive investing, the key is to stay consistent and patient. Investing is a long-term game, and the biggest wins often come to those who can ride out the storms and stay the course. One of the golden rules of investing is, don't put all your eggs in one basket. Imagine you're on a game show and you have to choose between two doors. Behind one door is a brand new car, and behind the other is nothing. You have a 50% chance of winning. Now imagine you have 10 doors to choose from, with 10 cars. Your chances of winning just went up, didn't they? That's the power of diversification. In the world of investing, diversification is the practice of spreading your investments across various assets or asset classes. It's about not putting all your money into one type of investment, like stocks or bonds, but rather a mix of different types. The aim is to reduce risk. If one investment performs poorly, others may do well, balancing out your overall returns. The importance of diversification cannot be overstated. It's a critical part of managing investment risks. Investing all your money in a single stock or sector is like gambling. You're betting everything on one outcome. If it doesn't go your way, you stand to lose a lot. But by spreading your investments, you're not relying on a single outcome. You're giving yourself more chances to win. Think of it as a safety net. If you were to walk a tightrope, would you do it without a net underneath you? Probably not. That's what diversification does. It provides a safety net for your investments, a buffer against the unpredictable nature of the market. But it's not just about risk. Diversification can also enhance potential returns. Different assets perform differently at different times. By having a diverse portfolio, you can benefit from the strong performance of various sectors or asset classes. Diversification isn't just about spreading your investments. It's about minimizing your risk and maximizing your potential returns. Investing is not a one-time event. It's a journey of continuous learning. As we delve deeper into the world of investing, it becomes clear that knowledge truly is power. The financial landscape is dynamic, constantly changing and evolving. It's not enough to simply make an investment and then sit back, expecting the returns to roll in. The most successful investors are those who make a commitment to stay informed. They keep a finger on the pulse of market trends, financial news, and emerging investment opportunities. They understand that the world of investing is like a vast ocean, constantly in motion, and they are the captains of their own vessels navigating these waters. Consider this. If you were to take a road trip, would you set off without a map, without any sense of the weather conditions, or without checking your vehicle's condition? Of course not. Similarly, in investing, being uninformed is like setting off on a journey without preparing. It's a risk that's not worth taking. Staying informed doesn't mean you need to spend every waking moment glued to financial news. It's about developing a habit of learning, being curious about how things work, and understanding the impacts of global events on your investments. It's about making conscious efforts to stay updated, whether that's reading financial news, listening to podcasts, or engaging in discussions about investing. But remember, the goal is not to become a financial guru overnight. It's about gradual growth, about building a solid foundation of financial knowledge that you can continue to build upon. It's about becoming a lifelong learner in the world of investing. And here's the best part. The more you learn, the more confident you become. You'll start to understand market trends, you'll start to make sense of financial news, and you'll start to make informed decisions. You'll become more than just an investor. You'll become a confident, informed decision maker. Investing might seem daunting at first, but with continuous learning, you'll become more confident and successful. So, make a commitment today. Commit to learning, commit to growth, and most importantly, commit to your financial future. Investing is a powerful tool that can help you build wealth and secure your financial future. And what a journey we've embarked on today. We've explored the magic of investing, from setting clear, realistic goals to understanding risk tolerance. We've dived deep into asset classes and investment vehicles and compared the dynamics of active and passive investing. Diversification, an essential strategy in investment, was also given due attention. And of course, we emphasized the importance of continuous learning in this ever-evolving field. Remember, the journey of investing starts with a single step. A step that leads you to a path of financial growth and security. It may seem daunting at first, but with knowledge and diligence, you can navigate the world of investing with confidence. Thank you for joining me today on this journey. If you found this video helpful, don't forget to subscribe to Online with Teresa. I'd love to hear from you, so please comment below. Until next time, happy investing.